The Phantom Event. It's January 28th, 2026. A few hours ago, the closing bell rang at 4 p.m. Eastern. And in that moment, something broke. Not the kind of break you hear about on CNBC. Not the kind that gets an emergency Fed press conference or a circuit breaker halt. No, this was quieter, more fundamental. The kind of break that happens in the plumbing of the global financial system before anyone realizes the entire building is flooding. I'm a private commodities analyst. I've been tracking physical silver markets for 12 years. And I can tell you with absolute certainty, what we're watching right now shouldn't be possible. The precious metals market just signaled what I can only describe as systemic cardiac arrest. Now, if you pull up any mainstream financial outlet right now, you'll see the usual narratives. Metals see speculative volatility. Technical glitch and yen carry trade causing metal spikes. One headline I saw earlier literally called it anomalous precious metal behavior tied to algorithmic trading errors. They're calling this a glitch. The math calls it an impossibility. Because here's what they're not telling you. We aren't looking at a rally. We aren't looking at a squeeze or a bubble or any of the normal market dynamics that fit into their comfortable little models. We are looking at the total rupture of the global pricing mechanism for precious metals. And I can prove it with numbers that should terrify anyone who understands what a Six Sigma event actually means. Because what just happened in the last 7 days wasn't just a move. It was a mathematical event that, according to standard probability distributions, should only happen once every few 100 million days. And it just happened 3 times in the same week to related assets at the same time. Let me be crystal clear about what I'm claiming here. The global financial plumbing is failing. We are witnessing what I'm calling a Six Sigma cluster, 3 separate statistical impossibilities hitting at once. And these events are proving, beyond any reasonable doubt, that the paper price you see on your screen is no longer connected to the physical reality of gold and silver. Not loosely connected, not temporarily disconnected, completely severed. Now, I know that sounds dramatic. I know it sounds like the kind of thing people have been saying for years. And I'll address the skeptics directly later in this breakdown because their arguments deserve a real response. But here's my promise to you. In this video, I will break down the Six Sigma mechanism in plain English. I will show you the exact math the comics is terrified of. I will walk through the on-the-ground reality that's playing out in Shanghai, London, and New York right now. And I will share the exact if-then battle plan I am using to navigate the Fed decision that's coming in just a few hours. Because here's the thing, whether you're a longtime stacker, someone who's been watching these markets for decades, or someone who just stumbled onto this video because the thumbnail caught your eye, you need to understand what's happening. Not what might happen, not what could happen, what is already happening. To understand why your screen is lying to you, we have to look at the numbers they hope you're too distracted to calculate. Let's pull this apart. I was looking at the data a few hours ago, right after the close. Here's where we stand. Gold closed at $5,388.82 per ounce. That's up 95% year over year. Silver closed at $116.54 per ounce. That's up 277% year over year. The dollar index, the DXY, is sitting at a 4-year low of 96.00. Now, if you've been following precious metals for any length of time, those numbers should already be making your brain do backflips. A 277% annual return on silver, gold nearly doubling in a year, with rates still sitting above 3%. But those are just the headline numbers. The real story is in the gaps, the arbitrage opportunities that shouldn't exist in a functioning market, the price differentials that are so wide, so persistent, that they're literally sucking physical metal out of the Western vaults and shipping it east. Let me show you what I mean. Right now, the paper price in New York and London is showing silver at $116. That's what your broker sees. That's what the futures market says. That's the official spot price. But on the Shanghai Gold Exchange, the SGE, which is the primary physical delivery market in China, silver is trading with a premium of $18 to $20 over the Western spot price. That means physical silver in Shanghai is going for $131 to $134 per ounce. Let that sink in. The same ounce of silver is simultaneously worth $116 in New York and $134 in Shanghai. Now, in a normal market, arbitrage traders would see that gap and immediately exploit it. They'd buy in New York, ship to Shanghai, collect the $18 premium, and repeat until the gap closed. That's basic market mechanics. That's how global commodity markets are supposed to function. Except they can't, because there's no silver to ship. The Shanghai Futures Exchange just reported a 35.9-ton drop in silver inventories. The LBMA, the London Bullion Market Association, is reporting surges in physical-only demand, not paper contracts, not ETF flows, physical metal walking out the door. And here's the kicker. That $18 premium isn't closing, it's widening. Stop. I want you to look at this clearly. This isn't a market, this is a heist. This is the East paying a massive premium to drain every available ounce of physical silver out of Western vaults. And the West is running out of inventory to sell. The price gap is real. The inventory drain is real. But the price gap is just the symptom. The disease is hidden in the statistical law of sigma. All right, let's slow down for a second. Because if you don't understand what a sigma event is, the rest of this breakdown won't make sense. And I promise, this isn't going to be a college statistics lecture. I'm going to explain this in the simplest terms possible because the concept itself is actually really straightforward. It's just that nobody in financial media wants to explain it to you, because once you understand it, you start asking very uncomfortable questions. So here's the deal. A sigma measures how far a price moves from its average. It's a unit of standard deviation. In a normal distribution, now the famous bell curve you might remember from school, most price movements cluster around the average. About 68% of all movements fall within one standard deviation, and about 95% fall within two standard deviations. As you move further out, 3 sigma, 4 sigma, 5 sigma, the probability of those movements drops exponentially. By the time you get to a 6 sigma event, you're talking about something that should happen once in every 500 million days. That's over 1 million years. Now, here's the key thing to understand. Markets aren't perfectly normal distributions. We get tail events more often than pure statistics would predict. That's called fat tails, and it's a real phenomenon. But even accounting for fat tails, a true 6 sigma event is extraordinarily rare. Think of it like this. If a normal market is a light breeze, a 3 sigma event is a strong wind. A 4 sigma event is a serious storm. A 5 sigma event is a hurricane. A 6 sigma event is a localized tornado touching down on your house. Now, here's what just happened. In the last 7 days, we saw a 6 sigma event in the Japanese bond market. The yen carry trade, one of the foundational structures of global liquidity, experienced a rupture that triggered a cascade of forced unwinding. At the same time, silver experienced a 5 sigma rally, followed by a 6 sigma intraday drop. The kind of volatility that statistically shouldn't happen in the lifespan of modern financial markets. And gold posted a 23% vertical monthly move. Not gradual, not a steady climb, vertical. We just saw a tornado, an earthquake, and a volcanic eruption hit the same house on the same Tuesday. And if you think that's a coincidence, I have a bridge to sell you. Here's why this matters. This proves that the normal distribution is dead. The assumptions that underpin every risk model, every value at risk calculation, every portfolio allocation strategy, those assumptions are built on the idea that markets follow predictable probability distributions. But when you get 3 6 sigma events in the same week, in correlated assets, and during the same global macro environment, you're not looking at random chance. You're looking at structural collapse. The price is no longer being driven by normal supply and demand by buyers and sellers making rational decisions in a liquid market. It's being driven by a breakdown of collateral, a seizing of the global plumbing, and a desperate attempt by institutions to unwind positions that should never have been allowed to build up in the first place. If you think 3 impossible events happening simultaneously is a coincidence, wait until you see the math behind the silver squeeze. Let's talk about the conservative scenario, the one that doesn't require any conspiracy theories or grand manipulation schemes. Just basic math and publicly available policy changes. On January 1st of this year, China implemented new export licensing requirements for silver. Only 44 companies are now authorized to export silver from China. 44. In a global market where China is one of the largest producers and processors of refined silver, limiting exports to 44 approved entities is the equivalent of installing a valve on a fire hose and cranking it 90% closed. Now, I want to be clear, this isn't speculation. This is public policy. You can go read the State Council's announcement yourself. The stated reason is strategic resource management and industrial supply chain security. But the effect is undeniable. Western silver supply is being throttled. And if the Shanghai premium holds, if that $18 to $20 gap remains persistent, then $150 silver isn't a moonshot prediction. It's a mathematical mean reversion to the Eastern physical price. Let me walk you through the math. If you're a smelter or a refiner in the West, and you can sell silver at $116 in New York or $134 in Shanghai, where are you sending your metal? Obviously, Shanghai. But here's the problem. You can't just freely export to Shanghai anymore. You need to be one of those 44 licensed entities. And even if you are, you're competing with every other Western seller trying to capture that premium. So what happens? The available float of physical silver in the West shrinks. The COMEX registered inventories, the metal that's actually available for delivery, starts draining. The eligible inventories, the metal that's sitting in the warehouse but not pledged for delivery, starts getting recategorized as registered to meet demand. And then, at some point, you run out. Now, there's a rumor circulating, and I want to be very clear that this is unverified, that the COMEX is considering implementing a liquidation-only setting for silver futures, meaning you could close positions but not open new ones, or, in the more extreme version, declaring force majeure and settling contracts in cash instead of metal. I can't confirm that rumor. I haven't seen any official documentation. But the fact that people are even discussing it tells you everything you need to know about how tight this market is. Because here's the gap analysis. The spot price is $116. But that's the price for metal that, increasingly, doesn't exist in deliverable form in the West. I'm hearing rumors, again, unverified, that some smelters are halting new orders, that refiners are quoting lead times of 6 to 8 months for bulk orders, that premiums on retail products are spiking to 20, 30, even 40% over spot. The price on your screen is for a market that no longer functions. So let's do a checkpoint here. We're about 60% through this breakdown, and here's what we know. The West is losing its metal to the East. The physical arbitrage gap is widening, not closing. The plumbing is breaking via Six Sigma statistical events that prove the normal models are dead. And the supply is being throttled by explicit Chinese government policy. Those aren't predictions. Those are facts. But if the math is this clear, why isn't everyone buying? Why isn't this the top story on every financial network? Because the skeptics have one final argument, and it's a good one. The skeptics. Let me steelman the bear case, because I'm not interested in building strawmen to knock down. I want to address the strongest possible version of the argument against what I'm laying out here. The skeptic says this is a blow off top. This is the end of a speculative mania driven by a yen carry trade unwind. Once the dollar index bounces back from 96, and it will, the metals will crash. Gold will give back half these gains. Silver will collapse back under $60. This is 2011 all over again. And here's the thing, I get it. I understand that argument. Because there are elements of truth in it. The yen carry trade unwind is real. When Japanese rates were negative or near zero for years, investors could borrow yen for essentially nothing, convert to dollars, and invest in higher yielding assets. That created a massive pool of leveraged positions. And when that trade reverses, when the yen strengthens and those positions have to unwind, it creates forced selling across asset classes. So yes, part of what we're seeing in metals is related to that dynamic. But here's where the skeptics get it wrong. This isn't just paper leverage. This isn't just speculative flows. This is a physical policy shift. China's January 1st licensing system isn't a trade. It's a wall. It's a structural change to the global supply chain that doesn't reverse just because the dollar rallies 5%. Let me put it this way. If the dollar index bounces from 96 to 100, does that magically create more physical silver in COMEX vaults? Does that reopen Chinese export licenses to non-approved entities? Does that close the Shanghai premium gap? No. At best, it might shake out some of the leveraged paper longs. It might trigger a short-term price correction as weak hands get flushed out, but it doesn't solve the underlying physical shortage. Now, the skeptics also love to bring up the old correlation. High rates kill gold. They'll point to the early 1980s when Volcker hiked rates to double digits and gold collapsed. But look at where we are right now. Gold is at $5,388. With rates at 3.5%, that correlation is already broken. The old playbook doesn't apply anymore. And there's a reason for that. In the 1980s, the dollar was backed by productive capacity, by a trade surplus, by a credible fiscal position. Today, the dollar is backed by the full faith and credit of a government running $2 trillion deficits with a debt-to-GDP ratio over 130%. Raising rates doesn't strengthen that system. It breaks it faster. Because every percent of rate increase adds hundreds of billions in annual debt service costs. At some point, the choice becomes defend the dollar and implode the federal budget, or devalue the dollar and protect the nominal GDP. And everyone paying attention knows which option they'll choose. So here's the final myth I want to bust. The idea that we're going back to normal. Stop. Look at this chart. These are the 44 companies allowed to export silver from China. Notice who isn't on the list. Notice how concentrated that list is among state-owned enterprises and strategic partners. This isn't a free market anymore. This is economic warfare conducted through export policy. The skeptics are betting on a return to normal. They're betting that the Shanghai premium closes, that the COMEX inventories stabilize, that the Six Sigma events were just statistical noise. But in a Six Sigma world, normal is a fairy tale. The old rules are gone, and the new rules are being written in Beijing, not New York. So what happens next? If I'm right, If we're in the early stages of a physical market breakdown disguised as a price rally, then the institutional response becomes predictable. First, watch for the CME to hike margin requirements aggressively. They've already done this once this month. They'll do it again. Why? Because margin hikes force leveraged speculators to either post more cash or liquidate their positions. It's a way to flush out the weak hands, the retail traders and small funds who are trading on leverage before the next leg up. It's not about protecting market integrity. It's about protecting the institutions who are short. Second, expect the narrative to shift. Right now, the mainstream media is treating this as a speculative event, a volatility spike, a technical anomaly. But as the physical shortage becomes undeniable, as the Shanghai premium widens further, as the COMEX inventories continue to drain, the narrative will change. They'll start framing it as a national security issue. Strategic resource preservation, industrial supply chain protection. They'll justify price controls, export restrictions, even potential confiscation. Not because those policies make economic sense, but because they need to contain the problem before it spreads. And third, watch for media blackouts on the specifics. You won't see detailed reporting on COMEX inventory levels. You won't see investigative pieces on the Shanghai premium gap. You won't see analysis of the 44 licensed Chinese exporters. You'll see vague references to market volatility and geopolitical tensions and algorithmic trading anomalies. Because the last thing the establishment wants is for the general public to understand that the pricing mechanism for critical industrial commodity has completely failed. So here's my dashboard. These are the 3 things I'm watching obsessively over the next 48 hours. 1. The dollar index at 96.00. If it breaks below that level decisively, we could see an acceleration of the dollar devaluation trade, which would pour gasoline on the metals rally. If it bounces hard, we might get a short-term correction. 2. The Shanghai Gold Exchange Premium. Is it widening to plus $25? If it does, that tells me the physical drain is accelerating and the paper markets are losing all credibility. 3. Unverified rumors of smelter backlogs. I'm talking to contacts in the refining industry. I'm watching lead times. I'm monitoring premium blowouts on retail products. Because if the physical bottleneck is real, it'll show up there first. The board is set. The pieces are moving. And the Fed speaks in just a few hours. Here's how I am personally playing the next 48 hours. I want to be very clear about something. This is not financial advice. I'm not a registered advisor. I'm sharing my personal plan so you can see how I'm thinking about this situation. But you need to make your own decisions based on your own risk tolerance and financial situation. With that said, here's what I'm doing. I'm watching 2 levels obsessively, the dollar index at 96 and the Shanghai premium gap. And I've built out 2 primary scenarios based on how the Fed decision plays out tonight. Scenario A, the Fed holds rates and sounds dovish. If Powell comes out tonight and signals that the Fed is done hiking, that they're in a holding pattern, or even more dovishly, that they're starting to think about cuts later this year, I expect the metal short squeeze to accelerate immediately. Why? Because a dovish Fed, combined with a dollar index already at 4-year lows, removes the last potential break on the precious metals rally. The carry trade unwind continues. The dollar weakens further, and the scramble for physical metal intensifies. In that scenario, I'm expecting a move toward $150 silver within weeks, maybe days. And here's what I'm doing. I'm maintaining my physical core. I'm not selling an ounce of my stack. I've been building this position for over a decade, and this is exactly the scenario I've been preparing for. I'm also tightening stops on my mining positions, because the miners have already run hard, and if we get a short-term volatility spike, I want to protect those gains while still maintaining exposure to the upside. I'm not chasing. I'm not adding leverage. I'm sitting in a strong position and letting the market come to me. Scenario B, the Fed surprisingly hikes to defend the dollar. Now, I don't think this is the most likely scenario, but I have to plan for it. If Powell comes out tonight and shocks the market with a rate hike, maybe 25 basis points, maybe even 50, in a desperate attempt to stabilize the dollar and contain inflation expectations, I expect a 15% flash crash in metals, maybe more. Why? Because a hawkish shock would trigger immediate liquidation of leveraged long positions. Margin calls would cascade. Stop losses would get hit. And we'd see a violent, fast sell-off as the paper market pukes out weak hands. But here's the key. I would view that as a potential final entry point. Because a rate hike doesn't solve the physical shortage. It doesn't reopen Chinese exports. It doesn't magically refill COMEX vaults. It just creates a temporary panic in the paper market. So in scenario B, I'm sitting on my hands during the initial crash. I'm not panic selling. I'm not trying to catch a falling knife. I'm waiting for the dust to settle, and then I'm evaluating whether the physical fundamentals have changed. If the Shanghai premium is still wide, if the Chinese export restrictions are still in place, if the COMEX inventories are still draining, then I'm treating any major sell-off as a gift. And finally, my terminal trigger. If the Shanghai premium widens to plus $25 or more, I will assume the physical drain is terminal and the paper markets are officially broken. At that point, I don't care what the Fed does. I don't care what the dollar does. I don't care what the COMEX says the price is. Because a $25 premium means the Eastern physical market has completely decoupled from the Western paper market. And once that happens, there's no going back. The paper price becomes fiction. The only price that matters is the price you can actually buy physical metal for. And that price is going vertical. Now, let me address something I know some of you are thinking. Why not just buy more right now? If you're so confident, why not go all in? Because I'm not a gambler, I'm a strategist. I've been in this market long enough to know that certainty is an illusion. I can be 95% confident in my analysis and still get wrecked by an unexpected central bank intervention, a flash crash, a margin hike, or a black swan I didn't see coming. So I build positions over time, I scale in, I protect my downside while maintaining exposure to the upside. I treat this like a campaign, not a single battle. And in a world of statistical impossibilities, the only mistake is assuming tomorrow will look like yesterday. And let me zoom out for a second, because I don't want you to miss the forest for the trees here. What we're watching isn't just about silver hitting $116 or gold hitting 5,000. Those are just numbers on a screen. What we're watching is the beginning of the end of the dollar-based commodity pricing system. For the last 80 years since Bretton Woods, the world has priced commodities in dollars. The dollar has been the reserve currency, the lingua franca of global trade. And that system worked more or less because the dollar was backed first by gold, then by oil, then by the sheer productive capacity and military dominance of the United States. But that system is dying. Not next decade, not next year, right now. The Six Sigma events we're seeing aren't random market moves. They're the system breaking under stress it was never designed to handle. The Chinese export restrictions aren't just about silver, they're about Beijing asserting control over strategic resources and challenging the Western monopoly on commodity price discovery. The Shanghai premium gap isn't just an arbitrage opportunity, it's a vote of no confidence in the paper markets. And the Fed decision tonight, whether they hike, hold, or cut, is increasingly irrelevant to the underlying physical reality. Because you can't print silver, you can't conjure gold out of thin air, you can't QE your way out of a physical shortage. And the East knows this. They're not playing the paper game anymore. They're accumulating physical metal, restricting exports, building parallel financial infrastructure that doesn't depend on Western institutions. And the West is running out of time to respond. Now, I know some of you are thinking, this sounds like conspiracy theory talk. This sounds like the kind of thing people have been saying for years. And you're right. People have been predicting the end of the dollar system for decades. But here's the difference. This time, we have the data. We have the Six Sigma events. We have the Shanghai premium. We have the Chinese export restrictions. We have the COMEX inventory drain. We have mathematical proof that the normal models are broken. And we have a geopolitical environment where the incentives are aligned for the East to push this crisis to its conclusion. So when I say this is the alarm sounding, I'm not being hyperbolic. The math doesn't lie, even if the screens do. The layers beneath. There's something else I want to address because I know it's on some of your minds. Why now? Why is this breaking now in late January 2026 instead of last year or next year? And the answer is, this didn't just start now. This has been building for years. Every quantitative easing program, every deficit spending bill, every time the Fed chose inflation over deflation, it added pressure to the system. Every ounce of physical gold and silver that flowed from west to east over the last 2 decades reduced the buffer that allowed the paper markets to function. Every Chinese policy shift toward resource nationalism, every Russian accumulation of gold reserves, every BRICS currency discussion, it moved us closer to this inflection point. And then, on January 1st of this year, China flipped the switch. They implemented the export licensing system. They stopped playing by the old rules, and that was the catalyst that pushed a stressed system into a breaking system. Now we're seeing the consequences play out in real time. The volatility, the Six Sigma events, the price dislocations, those are symptoms of a system that can no longer maintain the fiction, that paper and physical are the same thing. And once that fiction breaks, everything changes. Because if you can't trust that a COMEX silver contract will result in actual silver delivery, why would you trade on the COMEX? If you can't trust that the spot price reflects the actual cost of acquiring physical metal, why would you use the spot price for anything? The entire derivative market, the entire ETF market, the entire paper trading infrastructure, it all depends on the belief that paper is as good as physical. And that belief is dying, not because of manipulation, not because of conspiracy, but because of basic supply and demand. There isn't enough physical metal to back the paper claims. And the entities that control the physical metal are no longer willing to let the West dictate the price. It's that simple and that brutal. Let me give you some historical perspective, because context matters here. This isn't the first time we've seen a disconnect between paper and physical and commodity markets. It's not even the first time we've seen it in precious metals. But the scale is different this time. The speed is different. And the geopolitical stakes are exponentially higher. In 1980, when silver hit $50 an ounce during the Hunt brothers saga, that was a squeeze driven by a handful of wealthy individuals trying to corner the market. The system responded. Margin requirements were hiked. Trading was restricted. The price collapsed. And the system survived because the underlying infrastructure was still functional. The COMEX still had metal. The refiners were still producing. The supply chains were still operating. This time is different because the breakdown isn't being driven by speculators. It's being driven by nation states implementing strategic resource policies. You can margin call the Hunt brothers. You can't margin call the Chinese government. You can change the rules on retail traders. You can't force Beijing to reverse export restrictions. And that's what makes this so dangerous for the Western financial system. Because all of their traditional tools for containing a squeeze, margin hikes, position limits, trading halts, those tools work against speculators. They don't work against sovereign nations pursuing strategic objectives. China doesn't need leverage to buy silver. They have $3 trillion in reserves. They don't need COMEX contracts. They have the Shanghai Gold Exchange. They don't need Western approval. They are the largest manufacturing economy on the planet. So when they decide to restrict silver exports, to pay premiums for physical metal, to build stockpiles for industrial and monetary purposes, there's no mechanism for the West to stop them. And that's the checkmate scenario that's unfolding right now. The West built a financial system based on the assumption that they would always control the pricing mechanism, that paper contracts created in New York and London would always be the authoritative price, regardless of where the physical metal actually was. And for decades, that assumption held. But it's breaking now, not all at once, not with a single dramatic event, but steadily, inexorably, as the physical reality diverges from the paper fiction. And once that divergence reaches a critical threshold, once the Shanghai premium hits $25 or $30, once the COMEX inventories drop below some minimum viable level, once enough market participants lose faith in the delivery mechanism, the entire structure collapses. Not gradually, not in an orderly fashion, all at once. That's what Six Sigma events tell you. They don't tell you the system is under stress. They tell you the system is already broken and you're just watching the delayed reaction play out. So here we are. A few hours from the Fed decision, a few days into a Six Sigma cluster that shouldn't exist, a few months into a Chinese policy shift that's restructuring global commodity flows. And the question everyone's asking is, what do I do? And I can't answer that for you. I genuinely can't. Because your situation is different from mine. Your risk tolerance is different. Your time horizon is different. Your financial position is different. But I can tell you what I'm doing. I'm watching. I'm waiting. I'm holding my physical positions and managing my paper exposure carefully. I'm not panicking. I'm not euphoric. I'm focused. Because this is the environment I've been preparing for. Not hoping for, not rooting for, but preparing for. I spent years building a physical stack, precisely because I believed we would eventually reach a point where the paper markets couldn't deliver, where the price on the screen diverged from the price of real metal, where the system broke. And now we're here. So I'm calm. Alert, but calm. And I'm following my plan, watching my triggers, adjusting as new information comes in. That's all any of us can do. But here's what I'm not doing. I'm not pretending this is normal. I'm not gaslighting myself into believing that 3 Six Sigma events in 1 week is just market noise. I'm not trusting the screens when they tell me silver is $116 while Shanghai is paying $134. I'm trusting the math. I'm trusting the physical reality. I'm trusting the incentive structures, and all of those point in the same direction. Let me give you the 3-sentence recap. We are in a Six Sigma cluster that statistically shouldn't exist. China has cornered the physical silver market via export curbs, creating a structural supply shortage in the West. The West is running out of time to reconcile paper prices with physical reality. That's it. That's the thesis. Everything else is detail. Now, if you want to understand how we got here, how the COMEX inventories reached this breaking point, how the vault dynamics work, how the paper-to-physical ratio expanded to unsustainable levels, you need to see my previous breakdown on the vault drain mechanics. I walked through the entire structure, the eligible versus registered distinction, the withdrawal patterns, the delivery default risks. That video is the fuse. This video is the explosion. Go watch that next if you want the complete picture. And if you found this breakdown valuable, if it helped you understand what's really happening beneath the surface of these markets, do me a favor. Share it with someone who needs to see it, not to hype them up, not to scare them, but to inform them. Because the mainstream narrative on this is garbage. And the more people who understand the real dynamics, the harder it is for the institutions to maintain the fiction. We're living through a historic transition, the end of one monetary era and the beginning of another. And the alarm is sounding. The only question is, are you listening? It's evening here now. I've been staring at these charts, running these numbers, talking to contacts in the physical market all day. And I keep coming back to the same realization. This isn't about being a gold bug or a silver bull or a dollar bear. This is about recognizing when the rules of the game have fundamentally changed. For years, the paper markets set the price and the physical markets followed. That's how it worked. That's how everyone assumed it would always work. But the physical markets are in revolt. Shanghai is saying, we don't accept your price. We'll pay more because we have no choice. Because the metal isn't available at your price. And that changes everything. Because once the largest physical market in the world stops following the paper price, the paper price becomes irrelevant. It becomes a number that institutions report to each other, a fiction they maintain for regulatory purposes, a vestige of a system that no longer functions. The real price, the price that matters, is the price at which physical metal actually changes hands. And that price is diverging from the paper price by the day. I've been doing this for 12 years. I've seen rallies and crashes. I've seen squeeze attempts and manipulation accusations. I've seen every variation of precious metals drama you can imagine. But I've never seen anything quite like this. The statistical impossibility of the Six Sigma cluster, the brazenness of the Chinese export restrictions, the width and persistence of the Shanghai premium, the speed of the COMEX inventory drain. Every individual piece is remarkable. Together, they're unprecedented. And I think we're still in the early innings. I think most people, even most people in the financial industry, don't yet understand what's happening. They're still trying to fit this into their old mental models, still waiting for the blow-off top and the inevitable crash back to normal. But normal isn't coming back. We're in a new regime now, and the institutions that don't adapt are going to get destroyed. So watch the Fed tonight. Watch the dollar. Watch the Shanghai premium. But more importantly, watch the physical markets. Watch the delivery times. Watch the retail premiums. Watch the smelter backlogs. Because that's where the truth lives. Not in the press releases, not in the official statements, not in the spot prices on your screen. In the real world, where real metal moves at real prices to real buyers. And in that world, the alarm isn't just sounding, it's screaming. Stay sharp, stay focused, and whatever you do, don't assume tomorrow will look like yesterday. Because in a Six Sigma world, nothing is certain except uncertainty itself. And the only way to survive is to prepare for scenarios that the models say are impossible, until they happen. And then, suddenly, they're inevitable.